Retail inflation falls below target, repo rate cut possible, Finance Ministry signals scope for further monetary easing. New tax codes rolled out for online earners, social media influencers, traders to file under updated ITR norms. Credit card debt nearly doubled since last year. Experts warn of strain on economy and credit system. Namaskar, welcome to HYBIZTV. I'm Sashira. You are watching Business Talk. The Finance Ministry on Monday said there is room for the Reserve Bank of India to further cut the repo rate as retail inflation remains well below the central bank's 4% average target. Consumer price index based inflation has stayed under 4% since February and dropped to a 6-year low of 2.82% in May. In its monthly economic review, the ministry stated that core inflation continues to stay soft and overall inflation is significantly below RBI's target, creating space for potential rate cuts. Lower repo rates lead to cheaper loans such as home and car loans, which reduce monthly EMIs for the public. The RBI has already reduced the repo rate by 1% between February and June. The next meeting of the Monetary Policy Committee, which decides the repo rate, is scheduled from August 4 to 6. The RBI has projected headline inflation for the second quarter of the fiscal year at 3.4%, while actual inflation in the first quarter remained below its target. The central bank is mandated to maintain retail inflation at 4% with a 2% margin either way. The report also noted that inflation may stay below the RBI's forecast of 3.7% for the full fiscal year. Additionally, global crude oil prices are expected to remain low due to higher than expected output from OPEC and its allies, who increased production by 548,000 barrels per day in August. On the fiscal front, both central and state governments have maintained momentum in capital spending while sticking to fiscal consolidation goals. Despite tax cuts, revenue collections remain strong and continue to grow in double digits. If you earn money through platforms like YouTube, social media, stock trading, or commission based work, there is an important update regarding your income tax return. According to a report by Live Hindustan, the Income Tax Department has introduced changes in ITR 3 and ITR 4 forms, including 5 new profession-specific codes. These updates aim to ensure better classification of income sources and improve tax compliance. A new professional code 16021 has been introduced specifically for social media influencers who earn by creating content, running promotions, or featuring ads on digital platforms. Depending on your income, you will need to file either ITR 3 or ITR 4. If you are opting for presumptive taxation under Section 44 ADA, you will have to file ITR 4. Here are the new professional codes you should be aware of while filing your ITR this year. Commission agents 09029, social media influencers 16021, betting gambling businesses 21009, futures and options traders 21010, equity share traders 21011, for stock market traders, especially those dealing in F&O, code 21010 is now mandatory. They must report their income, profits and losses in Form ITR 3. Earlier, many traders filed under unrelated categories, making it hard to track their actual earnings. These new codes will help the tax department categorize income more accurately and keep closer tabs on high earning individuals across different professions. It is a move aimed at tightening compliance and minimizing tax evasion. In India, unpaid credit card bills that are overdue for 91 to 360 days have gone up by 44.34% in just 1 year. By March 2025, the total amount reached 33,886.5 crore rupees compared to 23,475.6 crore rupees in March 2024, a rise of over 10,410 crore rupees. These are bills that people haven't paid for more than 3 months. As per banking rules, such overdue amounts are called non-performing assets or bad loans. This data comes from a report by CRIF Highmark, a credit bureau registered with the Reserve Bank of India. The report also shows that overdue credit card dues have almost doubled since March 2023, rising more 20,872.6 crore rupees to 29,983.6 crore rupees. It shows two things. First, people are more dependent on credit. Second, many are unable or unwilling to pay their dues on time. The report also talks about something called portfolio at risk, which shows how much credit card debt is at risk of turning into bad loans. For bills unpaid for 91 to 180 days, PAR went up from 6.9% to 8.2%. For 181 to 360 days, it rose from 0.9% to 1.1%. This means more people are not paying their credit card bills for long periods. Credit card transactions reached 21.9 lakh crore rupees by March 2025, up from 18.31 lakh rupees crore in March 2024, a 15% increase. The number of active credit cards also went up. In May 2025, India had 11.11 crore active cards compared to 10.33 crore in May 2024. Banks and fintech companies are aggressively promoting credit cards with attractive offers like cashback and reward points, travel benefits, zero interest EMIs, airport lounge access. These benefits attract more users. For many urban users, credit cards have become a part of their lifestyle, not just a way to pay. But while swiping the card is easy, paying the bill is not. If dues are not cleared on time, interest can go up to 42% to 46% per year. People often fall for offers and rewards but end up with growing debt if they don't pay in full or on time. A sharp rise in unpaid credit card bill is not just bad for individuals but also risky for the entire financial system. Credit card loans are unsecured, meaning there is no security like a house or car against them. If defaults rise, it can hurt banks' financial health. Banks may tighten lending rules, making loans harder to get, which can slow down credit growth, a key driver of consumer spending and economic growth in India. Thanks for watching. Keep watching Habis. Namaskar.